Okay, I want to do some videos to kind of get you off to a good start uh, in our course for advanced accounting. Um, to do that, I'm going to walk you through some things with the consolidation process just to kind of help you understand the concept. And what will happen is as we go through the various chapters, you're basically taking the same things we're doing in these early chapters, but you're adding something else to it. For example, in another chapter you'll say, well, what about inventory? In another chapter you'll say, well, what about intercompany loans? In another chapter you'll add, so you'll be adding, building on what we learn in this early chapter. So chapter 2 is about consolidations and combinations, and chapter 3 is about subsequent years. So what about after year 1? How would you do a consolidation after the first year? So in chapter 2 we're focused on the first year. So the first thing they talk about in the chapter is the easiest, most or least complex, is probably a better way of saying it, consolidation. And that is when the parent company, which will always, usually has a P for the as the first letter of the name, buys the S company, and they buy the assets and they pay cash for it. And to make it even easier, the book value of the assets are the same as the fair values. So there's no goodwill, and we'll talk. Hopefully, we'll get to goodwill later on. But this is the easiest, most straightforward situation. You can see the two companies. Here's company P's balance sheet. Here's all the cash assets they have, the liabilities they have, and then they're going to acquire company S's balance sheet for $500. Remember, company S, which is being acquired, they're paying exactly the amount of the book value because they're assuming, we are assuming that that is the same as the fair market value. Why do they pay $500? Well, they're getting $600 in assets, but they're also getting $100 in liabilities. If you take the assets minus liabilities, that's your net worth. So we're putting this on company's P books. This is actually the journal entry that would go in the books for P. So you'll see that P's adding the assets, adding the liability, and then we're deducting the cash because they're used for the sale. After we purchase the company, you notice the company P's balance sheet has the reduced cash, has the accounts receivable of P and S. Company P's accounts receivables were $300 before, then they added $200 when they purchased S, so now it's $500. It was $100 first, then an inventory $100,000, and then they added another $100,000. Now it's $200,000. So you get the picture. There would not be any kind of consolidation entries necessary in this case because that journal entry did consolidate. It did combine the two companies. So there would be no further required, work to be done. Again, that you can see why this would be the most least complex type of situation where two companies, S and P, come together. Again, that was purchasing S using cash, buying their assets, and then buying them for fair market value, which happens to be the same as their book value. Okay, so the second situation is, what if company P doesn't buy the assets of company S, but just buys all of the stock? So it's going to purchase the stock in S instead of buying the assets. Kind of like an investment, right? So what would happen is that we would, in company P, put in our new asset as an investment and subsidiary S, and how much we paid for it, $500,000. Now, what does this mean to us as a consolidated company. If there's no control over S, so in other words, if maybe they didn't buy all the stock, or for whatever reason there's no control over S, then nothing else would need to be done. If you went back to the balance sheet, you would see Company P would have $500 less cash, but $500,000 more in investments. So there would be another account under inventory called investment, and that would just be the way it was. However, chances are there is control over S, especially if you bought all their stock. So if that's the case, then you have to do a consolidated set of financial statements. And in a consolidated set of financial statements, we need to take away, things. We need to make the two companies look as one. We need to put everything together as one, and areas where there might be overlay or double dipping, we need to get rid of that. So we're not going to do a journal entry that goes into the books. As you can see here, it says no journal entries are actually made to the books. So instead, we go through what they call the consolidation process. They say elimination process here. So they're going to have to do this every year, where they kind of show, I guess you could say, like a third set of books: the parents, the subs, and then a consolidated set of books. To do that, we're going to use a worksheet. And for all the consolidations, I've provided worksheets for you as templates. This is how you would do this kind of work in a real, in a real business. You would never do this kind of thing with just without a worksheet. You would always do a worksheet. So looking at the worksheet, what you'll notice is that you have the two companies' trial balances in a single column. Now this is very important that you understand. The single column situation means that debits are positives and negatives are credits. This is the only time you'll ever see a negative, in our accounting journals. You won't see an actual journal, but you'll see this on this type of balance worksheet. This is how the worksheets. This is how the two companies look before. You see there's the investment, and you see the cash, which was provided to us as $300 less. The stock was purchased from shareholders. That's why the cash amount did not go to Company S. As you see here, the cash didn't go to Company S. It went to the shareholders. But the investment did go up and the cash went down. So if you go across and you add these up, this consolidated balance sheet over here will be the sum of all of these things. So our eliminating entry means that we need to get rid of the investment and the stock, the equity side of Company S, because the assets and liabilities are going to be consolidated instead. So we're going to just go across, and we're going to get rid of the investment in S. So this is a debit balance, we're going to do a credit balance, so that will zero that out. Then we go across here, we just add those up, and then we want to get rid of Company S's equity. So we're going to do a debit to get rid of the equity. See the negatives? That means those are credit balances. And when you go across, you see that they zero out. You should have a journal entry, but they should always have a label next to each one, and then the debits and credits should always equal. Okay, that's good for now. Let's just think about these two least complex situations, and we'll do another video to a more complicated situation.